In this section, we address loans that lead to capitalized interest instead of interest expense. When a company takes on a loan specifically for the development of a long-term asset, the resulting interest is capitalized. What that means is interest does not get expensed immediately on the income statement via interest expense. Instead, it's included as part of the capitalized cost of the long-term asset, and it cycles out of the balance sheet not via interest expense, but via depreciation expense. The way to best understand this is with an example, so let's go through one right now. In the example below, a company borrows $100 million at 10% interest to fund a construction project. The impact of the loan on day one is as follows. Cash goes up from the loan by $100 million. The corresponding entry is the loan principal. So there are two things that are happening. Let's get to both of them. So the first activity is that you borrow the $100 million, cash goes up by 100, and liabilities go up by 100 for the loan. What do you do with that cash? Once you convert that cash, so cash goes down by 100, and you buy some fixed assets, or you buy some construction in progress assets. Instead of cash of 100, the net result is at the end of this on the balance sheet, you actually see $100 million in property, plant, and equipment because the cash debits and credits cancel themselves out. So let's draw that out. So at the end, what you see here is a canceling of these, and the net result is property, plant, and equipment of 100 on the left side of the balance sheet, or construction in progress assets on the left side of the balance sheet, and a loan on the right side of the balance sheet. Now, during the construction phase, as the construction is happening, while it's in process, the interest associated with this loan is capitalized. So at a 10% interest during year one, let's say the construction is still in progress, the capitalized interest accrues to the property, plant, and equipment balance. The offsetting entry is cash payments. So this, unlike PIK, we're not talking about accrued interest. Don't confuse this with accrued interest. This is capitalized interest, and it functions quite differently. We're talking about a cash interest payment. The company had to pay in cash to the investor, to the lender, $10 million. But the offsetting entry was not retained earnings like we're used to seeing. Instead, it increased the property, plant, and equipment balance on the left side of the balance sheet. And what ends up happening is now over the life of the asset, over the life of the construction project, the capitalized interest cycles out via depreciation. And what the useful life of that is a function of the useful life or the term of the construction project.